Hey traders, welcome back to Your Nifty Guy. I hope all of you are doing well. Let me be very clear. Today's market was not dull, not random, and definitely not meaningless. It was selective, it was deliberate, and it left behind clues that only disciplined traders will pick up on. In today's video, I am going to break down exactly what today's price action was communicating, where traders are likely getting trapped by noise, and how I'm structuring a clear, rule-based trade plan for the next session without prediction, without emotions. This is not about chasing moves or reaching late. It's about preparation, context, and execution. If you want to trade with that kind of clarity every single day, make sure you like the video, subscribe to the channel, and turn on the notifications because these daily plans are built before the move, not after it. Let's get straight into the analysis. Today again was a no trading day for me. A day which is extremely sideways. If we look at the candle on the daily time frame, it will be a doji, yes, a big, beautiful doji. Now, although on the 5 minutes or the 15 minutes time frame, we can see that the closing is near the highs of the day. Out here, we can see that the closing is around the midpoint. That is because of the adjusted closing. But for our analysis, I will pay more attention to the 25,000, right? On the lower time frame, what you can see is the closing is 25,970, whereas on daily, if you shift the time frame to daily, you will see that the closing is 25,938, right? So there's a difference of 35 odd points, but that is because of the adjusted closing wherein the average pricing of the last 30 minutes is taken, and you will also see the same figure out here. But then my analysis is built on the intraday analysis is built on this particular these levels. So today market trapped people on both the sides. Now, why do I mean both the sides? First, people who shorted the markets at the break of previous day low were trapped when markets moved up. Second, anybody who would have traded the break of this particular day's high would creating long entries would again have been trapped, right? I was also talking to Siddesh about the trap setup being in the formation, and what I told him was, do not rush into the entry after the break of day's high. The market is coming down from a lot from the bottom, right? And wait for a significant pullback, and only after the break of that pullback can you take a long entry. That was my suggestion to him. And the reason behind the same is if you enter into a long out here, there are two things which are going against you. Number one, the market has already moved quite a bit. So the probability of moving further higher up from here becomes a bit tad difficult. The second being the most logical stop loss if you are entering out here would be the day's low, which in my opinion is a big stop loss. So say for example, if after this particular move, right, after this move, if markets would have continued high up, we could have entered at the break of this high with this low being the stop loss. So that was the reason behind not entering into the trap setup also. This is exactly what I uh, signify and which what I mean to tell you guys about that we need a bearish candle which closes below previous day's low, and when the high of that candle gets taken out. So this is exactly the trade that I am looking for. The trap also was there, right? But then again, try to understand the market did take a significant amount of time in trying to come up here. Significant amount of move which had already happened, and that was the reason why we could not have traded this particular setup. Had this particular setup been, say, for example, we would have opened with a gap down, and then out here, if it would have been broken high, the high would have been a bit low on the lower side. We could have easily traded that, right? So these are basic things that we need to keep in mind, even though the market is giving us a trade as per the plan which was there. Okay, we got a bearish candle, check. The high of that candle is also equals to open, which is again another great check. That means sellers entered right at the beginning, and the high of that candle is also getting taken out. So do we enter at the break of this particular high? Absolutely not. Had this been a different price action scenario, I will be explaining it to you in future videos whenever the scenario happens. But then for today's case, yes, the bear trap was there, and then again there was a bull trap as well, whereas people who would have entered into longs at the break of this high were completely trapped, and then markets again came tumbling down very close to the day's low, did not break it. Uh, again formed a double bottom, but then again this was below a significant level, could not be have been traded, and extremely sideways price action throughout the day. And even if you were to observe the open interest data, right? So there was a good amount of call writing above, a good amount of put writing below, which was like a good amount of strangle is already into play by the big players, and the markets going anywhere was highly questionable until unless one of those big call or put writing levels were being taken out on the spot. The move would not have come on e one of the either directions, right? And that was the reason why, again, no trading day for me. Plus, like I had also mentioned, volatility expansion leads to volatility contraction. Last couple of days since this high, we have seen good trending markets. Not surprising at all to see a sideways market. The option selling trade that I was into performed very well. And these are the days for option sellers, and as an option buyer, you should know when to stay out of such days. For tomorrow, we will again on the daily time frame, we have a doji, which means a good indecisive candle which is forming around the daily time frame fib levels. Now, like I have mentioned before as well, we have gone down and breached below these levels does not mean that uh, the markets has completely reversed, right? The number one pointer is because the level of retracement can either also the markets can reverse from these levels as well. The markets can go down below these levels, but before the 0.786. So 0.786 I consider as the borderline in case if the market breaches the 0.786 fib levels. I do not take the thing as a valid retracement, but then I consider that as a reversal. But till 0.786, it's comfortable and it's cool. But I pay most attention to the zero point 0.5 to 0.618 zone. That is why that is the only level that is marked on my charts. But then we have retraced down to these levels. Now, on the smaller time frame, we have got a good amount of positive price action, I will say, at a important support area. I will be adjusting the fib levels based on the new low that was created today. Right? Also, this simply needs a minor adjustment. All right. Now, the plan for tomorrow. Number one plan, we are absolutely long above these level. I will treat today's price action as a no trading zone for people who are not uh, on the defensive side, right? Not aggressive traders. Please wait for this levels to be taken out. Create a long entry. A beautiful trade awaits. For people who are a bit aggressive, you can also enter into a trade or into a long trade at the break of today's high simply because today's candle is positive. Plus, on the daily time frame, it's a doji showing indecisiveness. A break above that high, we can enter into a long trade as soon as that happens. In case if we observe negative price action around these levels, right? So this is the hourly time frame that I'm talking about. If we are approaching these fib levels, and if we see some negative price action around here, we can definitely take a short entry at these levels as well. Try to understand the difference between this and this is solely and solely based on how the price action is developing in the live markets, right? And of course, needless to say, below this, we are looking for a short trade. So overall, that's going to be the plan for tomorrow. Remember, the market doesn't reward excitement, it rewards discipline and preparation. If the price confirms, we execute. If it doesn't, we stay patient because protecting capital is also a winning trade. If this breakdown added clarity, make sure to like the video, subscribe to the channel, and share it with a trader who needs structure, not noise. I'll be back with the next update tomorrow. Until then, trade what you see, not what you feel. On that note, I will sign off for today. Cheers and thanks for tuning in, guys. Thank you so much.